Hey, this is Rod Cleef, and you are listening to the Mailbox Money Show with Bronson Hill.
All right, welcome to the Mailbox Money Show. I'm your host, Bronson Hill, and I'm super excited. I have my good friend Curtis May here with me, who's going to talk about your strategic financial plan. Now, a lot of times what'll happen is that we just simply, I like this deal here, or I invest with these guys over here, or I do some multifamily or some oil and gas, but there's no central plan to kind of bring it all together. And Curtis, in this interview, he talks a bit about just some different strategies to do that, as well as having things like infinite banking, which is basically a life insurance policy that you can borrow against, and some of the strategies of it, right? So I think that those are things that are very valuable, and I think that traditional finance folks that just talk, even the people that the gurus that are out there, they'll say, "Oh, just save money or just invest this way," but they don't really get into the specifics of how you actually do that. So we're going to get into this in this interview. I hope you enjoy it. Looking forward to it. Let's go. All right, welcome to the Mailbox Money Show, and it's great to be with you today. It's great to be with my friend Curtis May. We just recorded a minute ago, and we had an earthquake in in LA, which is unusual, and so my heart rate got going. But we're back to recording now, and I'm sure when you have an exciting podcast, exciting things happen. So I'm
That's
excited to chat with you. We just recently had I was on your show called the Practical Wealth Show podcast, and we had a great conversation about finance, about alternatives, and really getting outside of Wall Street. And so why don't you tell us, Curtis, first of all, welcome. Give us a little bit of your background and how you kind of got to be an alternative guy that's doing things outside of traditional finance.
yeah. I started out basic. I might have you with when I first got into the business, I was kind of like Dave Ramsey on steroids. Right? So, and I think it was I'll date myself. 1985, I was a junior in college, and I realized the NBA was not looking for 5'11" shooting guards. And that's what started my financial services career. And somebody showed me a check for $400. So this one I made for hours worth of work. I said, doing what? And then I just went, being the nerd I am, I went down the path of education. So I was I was registered you would know the 663,
Yeah.
26. I did all that stuff, mutual funds, setting up 401ks. And then in 1999, 2000, I read a little purple book called Rich Dad Poor Dad.
Yeah.
And then I started to wait, what he's talking about and what I'm doing are not the same thing. And my family had always been self-employed. So some of this I didn't, you start to connect the dots that, okay, I've been around business owners and they're making money and are becoming rich without this stock market thing. And I thought the stock market was the end all be all. And
Right.
then as I started just going down that rabbit hole, and living through 3 or 4 crashes, with the your what are those people called, the wholesalers, the
Yeah.
telling you, well, don't worry, the market's going to come back. I got sick of that, and I started to learn, well, what is true, what do people do? And I just, when I read a book, I read through the bibliography. And then I didn't discover it. Right after that, I read another book called Becoming Your Own Banker. um and working my way through the bibliography of that, I was like, I started to form a different paradigm,
Yeah.
about money, about control, about cash flow. And I didn't really, it took me another 5 years to figure out what to do with this, in
Yeah.
terms of putting it together. But I realized that, okay, I didn't think that just hoping the market goes up was a good strategy. I didn't think hope was a good foundation for a good game plan.
Yeah.
And that's so I've kind of built on that to what I do now, which is called principles-based planning, where we try to teach people, similar to what you do. I teach people principles that help our clients become and remain financially free. And so that's kind of what I
Mhm.
teach now.
Yeah, and it's interesting. I think one thing that's really fascinating to me with all the calls that I've had, over 2,500 calls with millionaires, is that they have different beliefs around money. They have a different mindset and they have different habits. And I know you're a big personal development guy, so you've seen this. And if you look at ultra wealthy individuals, so there's a group called Tiger 21, and the average member is worth over $20 million. How they allocate their capital is very different than people that are middle class. A lot of middle class own a lot of stocks and bonds and other things like that. People that are ultra wealthy, they have over 50% of their net worth typically in either private equity or some sort of private deal, syndications, commercial real estate, things like this. And so it's amazing how you become more wealthy, you start to make these connections and just realize that the things we're taught, such as stocks are safe and everybody should have index funds, whatever. It's a roller coaster, and so you got to
It's
kind
like
of
the
look up.
opposite. That's what it started. It was fascinating. It is literally the complete opposite.
Yeah.
Rich people do it's not like
Yeah.
Kiyosaki would say, it's not different, it's opposite.
Yeah.
It's a
Yeah.
completely opposite. And so what I found is there's two games going on, right? So there's what I call the accumulation theory, right? Or what typical planning is around, which is buy and hold, dollar cost average, get out of debt, buy term investor difference. But then the world, from reading your book, and which solidified even more for me, right? Which is, if you look at the what I call the velocity method, which is velocity of money, cash flow, leverage. um they're not trying to get out of debt. You want to go into more debt, but there's good debt and bad debt. There's risk management, so a lot of insurance to protect yourself from downside risk. I mean, it's just literally a complete opposite thing. I interviewed Barry Dyke on my show, who the book called Pirates of Manhattan. And these institutions and banks store their capital in permanent life insurance, right? So what I've discovered is that those strategies work in personal finance. They'll work for middle America. They'll work for upper middle America. And if you don't begin to learn that stuff, you'll always be on that roller coaster.
Yeah.
You know?
Well, it's something, I was working, for 10 years in the medical field. I worked with a lot of physicians, and in California, we have state income tax as well, up to 13 point something percent. So people are paying, most physicians are paying over 50% in taxes. So they just, put it into retirement. They do different things. They try to, if they're good or they're smart, maybe they have a business and they kind of run it through there, so able to reduce some of that personal income. But it's rough. And so, but when I talk in my book about, it's possible to reduce your taxes even to zero. I went from a 25% taxable rate to about a 1%. And, I think that stuff is possible. And I think that the problem is a lot of people that, it's so mainstream to have all the Wall Street stuff because they spend so much in advertising. And for you, it's like a few of us, I don't know how old you were when you got this message of I should do things outside of Wall Street, but what do you think are I mean, is it just simply the money? It's the money is not there for the advertising, so that they look at it what we do, and they say, well, that's alternative investing, right? That's not like, and it's like, well, there was a time when the
Not
stock market
alternative
crashed.
for people with money. That's what they do.
Yeah, yeah, I know. Yeah,
I think that, because see, what people want I think this is the problem. See, people want easy. So what the marketing sells easy, because their basic premise is you don't have the time, the temperament, or the training to personally manage your own money. So basically, in so many words, all their marketing says, give your money to us with your number, right? And so they sell easy, just max out this thing and get on with your life and we'll take care of you.
yeah,
And so that's what people want, but that's, you gotta want control. And so, I always share, like you're on your book's on my recommended reading list now, is for our clients, is that investing is more about becoming something than it's about buying something, right? And becoming is like you've become an investor, a real investor, what Kiyosaki will call in his book Faith, and you're a real investor. And so that's work, that's time, that's effort, that's study. And most people unfortunately, don't want to do that. It's not, he would say investing is not risky. Being uneducated is risky, but being educated is work. And most people don't really, really want to do that. And I think that's the problem. We want easy. We're sold easy. I make 200 grand a year. I'm a $500,000 a year. I'm a physician. Well, I don't have time to worry about all this other stuff.
yeah, yeah, exactly. So you have a bunch of stuff you've created, some different topics. I'd love to get into some of your work. Talk to us about accumulation theory versus, or in the velocity of money strategy. So just give us some idea of what you were talking about when you.
So when I said accumulate, mostly the word is around, you should be saving money. And so people think putting their money in a 401k is saving. First of all, it's not, it's investing.
Mhm.
And so the accumulation theory is this theory that you can put money away in the primarily the S&P or in the stock market, and then at 65 or 60 or whatever, you'll have some pile of money, and then you can live off of that pile of money and hope, here's that word again, that you don't die before you run out of money. That's most people's plan, I hate to say, right? And so the problem with the accumulation theory is that there's so many moving parts to that, right? You've got fluctuating markets, you've got government regulation, you've got depreciation of the monetary unit called dollars. So what you might get, and you say, look, I got $1 million, but okay, 20 years from now, I may buy $400,000 worth of stuff. But you see $1 million in your account, and then you still haven't counted the taxes. So you've got so many moving parts working against you with the accumulation theory, I call it. And so it's hard. I asked somebody the other day, I said, listen, well, if you had $2 million, you think you'd be okay in retirement? He's like 51. I said, yeah. Well, first of all, it was nowhere near that. All right. And I said, so the safe withdrawal rate that Wall Street will let people show their advisors is like 4%. So he was making like 120,000. I said, well, 4% of 2 million is 80,000. So even if you had it, it still wouldn't work.
Mhm.
Right. And so
Right.
one of the exercises I take people through, Bronson, is retirement ready or not. And I use it to show people, look, you need to do something in addition to, you need to do something that sends you a check every month. So
Yeah.
which brings me to the velocity method. So velocity is an economic principle. It's not an investment, right? And it's just moving money through assets. So in real estate, that would be the Burr method. I spoke to this business group, the Laundromat Millionaires. And so velocity for them was bigger newer machines that turned over to wash faster, dried faster. You could bigger barrels so you could do more wash faster. So you can get people in and out of the mat. So you can get a new customer in it. That's velocity. So,
Yeah.
you want to put Mr. Wonderful, you look at Shark Tank, he wants, how soon am I get my money back? So you
Yeah.
can do what? Put in another deal. So that's Ken McElroy, all those guys. They want to move their money, and then they want cash flow. So they want to put money out, that because if you're getting your money back, your risk goes down because you're getting your capital back, and then you want to be able to put that money into another deal. So velocity is all about having money moving. And so whereas we're taught by the powers that be to keep it, basically stick it on a shelf and let it collect dust and accumulate. Meanwhile, they're taking our money and they're creating velocity and cash flow.
Yeah. Yeah. Yeah, it's
You
so
know,
true. No, and it's interesting. This actually, you mentioned about insurance too. I know Warren Buffett at one point, he started, or he bought an insurance company so he could take the money that was coming in for premiums and go invest that and have that velocity principle like you're talking about. And then when payouts would come, they would just pay the payouts. But it's like they call that the float, right? The money that would come in
right?
to be able to have. But it's interesting how everybody, we put our money in the bank, we put it in a Wall Street thing. They are able to use this money and be able to use our money to go make money on it. But it's something a lot of people just don't really think about. And how do you actually get your money working for you in a faster way? Like you said,
We
Mr.
call it
Wonderful.
the financial physics, right? So I try to teach, but I was doing a train on this Saturday morning, and I said, look, I was reviewing Become Your Own Banker, and it was like there's only one pool of money. This is what people don't get, right? So it's controlled by either banks, Wall Street, or the insurance companies.
Yeah.
And so there's only one pool. So when we talk about being a bank, all that is creating a pool of money that you control. So what of those three industries allows you to kind of have your cake and eat it too? Life insurance, mutual life insurance companies, because you own the company. When you pay premium, if it's structured right, you they're managing that pool of cash like a bond fund, but you have access to it. You can collateralize it tax free, and you can use that money to buy into things that you're offering, or real estate. Or I've got a client that borrowed 12 grand, has got two rental cars, and now he's making like 2 grand a month in cash flow off of leveraging his cash, and the money and the
Mhm.
cash is still making money, and he's generated 24,000 a year asset. That's velocity, as opposed to, hey, I'm going to keep putting money in this thing and just let it sit there and hope it makes me wealthy. There's no financial product. This is my problem with the industry. There's no financial product in of itself is going to take you to glory financially. There's just, and so there's no success in a product because there's too many
Yeah.
things that change. So you can't put your faith in, oh, this is the greatest mutual fund index ETF, and this is going to ride me to financial freedom. It's not.
Yeah, no, I think that's one thing I've realized. I was having a conversation about this yesterday that, the traditional strategies were taught, and as being a recovering investment advisor, the stocks and bonds, and even somebody asked about Dave Ramsey, and I was like, I think Dave Ramsey is great for a lot of people. I think 80% of people are in credit card debt and they spend more than they bring in, and I think that that's kind of a 101. Like there's some things there,
Right.
but you'll never become wealthy they're using through Dave Ramsey or through these other traditional methods, because it's more about preserving and just not losing what you have.
Right.
Versus if you actually, like the example you gave of like, well, if you actually want to create assets, you actually want to get things working for you, you have to look outside the box. And every single person that became very, very wealthy, they did stuff that was totally against the tradition. And so I guess for people that here's another thought that I've learned, and through a study, there's this thought that people are either born with money, or they come from money, or they have all this network or things like that, or they're not. And I think the reality is Fidelity Investments did the study, said 86% of millionaires are self-made. So if that's the case, it means these are learnable principles, the things that people did. What are some things that you observe of individuals that are really, they go from being a place where they're not wealthy to they develop wealth over time? And you've been doing this for quite a while. Would love to know kind of what some of the mindset.
Yeah, so what we've tried to, I was doing this, and I got taught a methodology over the last 3 years, so to kind of organize it into 5 points. But before that, it was the 7 cures for a lean purse from the richest man in Babylon. It's still that,
Yeah.
basically, So because human nature doesn't change and principles don't change, so it doesn't matter who has them. So, like the basic things are like we talked about it, spend less than you make.
Hmm.
Right? You got to control your cash flow. I mean, like, there's nothing
Yeah.
magic about that. If you can't make 200 and spend 215, you're broke. You're a higher level of broke. You got more toys, and you're really using what most people do, Bronson, is they use future income as collateral,
Yeah.
which is debt, right? And so they're
Right.
they pulling money, they spent money they have not yet earned. So now they're servicing the debt, which messes up their cash flow, and they have less money to save because they're buying stuff they have to pay for instead of buying real assets.
Yeah.
That's like basic, like block and tackling, right?
Yeah. Yeah.
Spend,
Sure.
pay yourself first, spend less than you make. But then we teach, my 5 principles real quickly, and we can go deeper in anything you want to, but I'll lay it out there because because it's two things really. So when I don't think I've done 1,500, but I've done a lot of interviews of these people like you and other people, through my show, and I see the principles there. So it's save, it's protect, max. A lot of people, when I'm talking with a lot of investors, this is why I say I'm the planner to the business owners and investment people, because I'm the defensive coordinator. So you're already in velocity. You're already making money. You don't need me for that. You are your best financial advisor. I tell people that all the time. But I'm going to make sure you manage cash flow. Most wealth is lost by how people manage cash flow. You need to
Mm.
save 15-20% or more of your gross income. Here's where people drop the ball. I teach a principle called maximum protection. So it's like Game of Thrones, right? You got a castle. You have to build a moat around your castle, which is things like asset protection, which are things like proper coverages on your auto and home, and umbrella coverages. What if you get hurt and you can't work? Disability, wills, trust. That's your moat. So a lot of people, because they have a bunch of what I call uncoordinated financial actions, they have, people doing different components, but they don't talk to each other. They don't have like what I call a macro manager. Like, I serve as like the macro manager. I see everything, and then I help work with their specialists, your mortgage people, your this and that. But I think from a macro standpoint. The third principle that we teach and that I see when I talk to these people is legacy. You need full replacement of assets at death, guaranteed. So how do you keep the money together, as Rockefellers would say? The fourth principle, and I find that people drop the ball here, liquidity. They don't, they always, sometimes they just want to keep money moving, and they don't sit on enough cash, right? And so I had a mentor tell me, listen, if you have money, opportunities will find you, because those with the goal make the rules. And so you just need to be able, like Buffett is sitting on what, $180 billion cash. Why is that? Because he's waiting. That's a good question. Why is that? Why is Apple keeps all this cash? Why do they do that? And they have the debt. Why don't they pay the debt off? Because it's stupid to pay the debt off, because it's a balance sheet neutral decision. So that's just like, how you have to look at your numbers differently. And then my fifth principle is velocity over accumulation. So we know about the accumulation theory, but what I've discovered is that you can't eat equity. Okay.
Yeah.
So I was listening to somebody like, oh, your net worth, your net worth, your net worth. Net worth is important, but it's really a lag indicator, right?
Yeah.
And really what you want to, the index I want people to track is, well, what's your life cost, and do you have passive income equal to or greater than your expenses?
Yeah.
And
That's the
that's your
right base
metric. I
number.
think that's what you focus on.
Yeah.
So we
Yeah.
call that velocity, because your goal is to become financially free. And I
Well,
don't
it's,
think people are clear on that.
yeah, I think it's it's cash flow 101. It's the game, right? You get to try to replace the rat race number, which is not, I used to think, making 200K a year, working medical sales, I had to replace that number, but I realized I was only spending 70K on my expenses. So if I covered that number, I was actually free. And so, once you cover that number, it does get you to a place where you are financially free. And I think that people, I think in terms of that, a lot of people don't realize how passive income really is different. What would you say to someone who doesn't have any passive income, who's like, yeah, I want to try this investing thing? And what are some things to consider when looking at getting, obviously there's a strategy where you're kind of active. It's a little bit, it's not passive, but you're running a Turo business or a rental car business or something. But there are other strategies where it truly is passive. What I guess research or advice would you give people to look into?
Read and research, right? I think you have to get like, so our three rules of investing are: invest in what you know, or invest in knowing. Okay. And so even if it's syndication, invest in knowing the operators, invest in doing due diligence, invest in what I remember in your book, you're like, there are some people that had a problem with giving up control, right? So I say invest in what you control, or you can influence the outcome, or does it cash flow, and don't chase returns. So I think that you have to know what you're like. I think it starts with, what do you want? See, if you know that you want cash flow passive income greater than expenses, then that kind of dictates what you do from an investment standpoint.
Yeah.
And so I think you have to decide what you want to be when you grow up. Because a lot of times I'll see people, and we'll go over there, what I call their personal economy, their income, their balance sheets, and that kind of stuff. And they say, well, you want to become financially free. Well, if I looked at your financial statements, what I see, that's your goal, because I'm looking at them and I don't see that you got all this money going into qualified plans. You tell me you want to be a real estate investor. You don't have any liquidity. You don't have access to other capital. So you have to kind of reorganize what you're trying to do, so that what you're doing with the money matches up. So I think that you got to decide, one, what you want, if that's what you want. And then I think there's four asset classes, right? So there's business, there's real estate, there's paper, and commodities, right? And so I think you have to decide what you like. So paper, most people gravitate towards paper, stocks, bonds, mutual funds, ETFs. But I got clients, they do private lending, right? We've got clients that do notes, they just bypass the real estate altogether, and they just buy the note and they get cash flow off. I got a young guy, he's like 34, making like 25, 30 grand a month on his note business. Haven't worked an honest day in his life, honest day in like 5 years, right? And
Right.
he's just buying these notes, and he don't even, he just every time they pay their mortgage, he gets a check, and so
Yeah.
he's just chilling. And
Yeah.
there's tax liens. There's what was those things called? Tax lien, life settlements. So there's
Yeah.
stuff out there, but you have to know they're out there. I think that's why your and I show exists, to just, my role is to let people know these things are out there. I think you have to do your own research, but I want people to get their foundation right. Are you saving? Do you have liquidity? Are you working at being productive, so that why do you want to be productive? You want to be the best in class, so you have good active income, so you can be a credit investor, so you can go into the 202, right? From the game, because you have to be financially independent, but then you got to be accredited, so that some of the stuff you can't even do by law, right? Because you're not there yet. So a lot of people think, I tell people, I'll tell network marketers or people in business, you need to get good at your thing, so that you can make $200,000 or $300,000 a year, so you can start to do some other the really cool stuff out there that's not available to you.
Yeah. Yeah. You've got to figure out what your edge is and what you can do. Hey, Curtis, I wanted to ask you, as we're kind of wrapping up, I know time's gone super fast, but for you, what advice would you give to somebody who, or if you were to go back to yourself at 20 years old and you were to say, here's, here's something I think you should consider, or what you should do. Here's step 1, 2, 3 of what you should do when you're just getting started.
It's funny. I was just working on that. I had it in my journal. I was like starting from zero. What I
Yeah.
tell myself at 20. And so one is manage your cash flow. Like most wealth is lost by how people manage cash flow, and change how you manage. Don't budget. We call it mapping. As a whole thing where I teach people how to create a reservoir so that savings comes first, and because savings right now is conscious and spending is unconscious. I want to flip it, and we actually do this so that spending is conscious and savings is unconscious. So step 1, control your cash flow. Then what I've realized and wish I'd have known earlier is permanent insurance. Whole life insurance is not the devil like I thought it was,
Mm.
because I was following Dave Ramsey. It was buy term, invest the difference. Everybody else is evil. You're ripping you off. And I didn't discover what I knew about permanent insurance until I was well over 40. And so I'm pissed, right? Because I had my insurance license since I was 20. So I would have put more money at the little money I was putting away and SEPs and stuff. I'd have run it through insurance, and there was all kinds of things I could have financed had I had, just saved consistently and not always have to stop and start or stop and sell my shares to do something else. And I would have uninterrupted growth curve, into what I was doing. And then I probably would say, Curtis, you need to, because my dad didn't love real estate. So he kind of passed that on to me, where I was always just trying to grow our business. And I said, Curtis, you need to buy 1 unit a year. Okay, at least.
Yeah.
If I'd have started that, like 25-ish or so, which I could have. Properties in Philly were really cheap, and I just didn't know.
Yeah, yeah, absolutely. No, I think that's great advice, man. Well, I appreciate all the value you're bringing. I know we just had a few minutes today, but I encourage people to check out your resources, check out your show called The Practical Wealth Show, and you help provide these services for people, and you help work with people, which I think is great. I think it's great when people are looking into alternative strategies. How can people follow you? How can they reach out? How can they connect with you?
Yeah, follow me on YouTube or LinkedIn, but really YouTube and on the Practical Wealth Show. I think YouTube, we put a lot of 2 or 3 videos out a day, so you can find out more about what I call the madness that is Curtis. Okay. And check out our show, practicalwealthshow.net. I actually have a free gift for your listeners, Bronson. So you can put in the show notes, because my assistant just sent it to you.
Sure.
And then I would send you, I just created this. Hold on, I don't remember the title. So I have a lot of y'all, I'm known for doing infinite banking. So I have like a free report called Infinite Banking in Real Estate. A lot of your people are real estate investors. So if you will just text infinite INFINTERE to, the number is 81833 422-0250. If you'll text Infinite RE to that, we'll send you out that report. It's like 5 or 6 pages, but it's really chock full of
Yeah,
information.
yeah. We'll put that in the show notes so people can reach out to that. But awesome, brother. Well, I appreciate all the value you're adding to people. I love the unique approach that you have and all the things you've created, and look forward to connecting with you again soon.
Yes, sir. Thank you for having me.
Thanks so much. All right, that was a great interview with Curtis May, and I hope you have a financial plan. If you don't, it's important to create something. What are you looking to create for yourself? Typically, if people are not higher net worth, they're looking to grow income, they're looking to grow wealth, they're looking to try to generate more. If you have a lot of resources, income, your net worth of 2 to 5 million or more, then typically you're looking at, okay, how do I allocate this? What do we need to do? What are the tax strategies in place? What are the things that you've created? We've created recently a mastermind group called the Wealth Forum, where we have a small group of investors. We talk about this, and we're really excited about it. If you're interested in hearing more about that, please do reach out. If you haven't joined our investment club, go to bronsonequity.com or click the link below, and you can join our investment deals, and we'll set up a call with you and start a relationship with you. So we're seeing some unique stuff in real estate, outside of real estate. It's important that you continue to educate and learn and really invest into yourself, because that's the biggest investment, best investment that you can make. So I appreciate you taking the time to educate yourself. Look forward to seeing you on the next episode of the Mailbox Money Show. You've been listening to the Mailbox Money Podcast. For more free resources, articles, and videos, go to bronsonequity.com. There you can download your copy of the special report, The Single Best Investment Strategy During and After a Pandemic. None of the information shared here is an offer to buy a specific investment, and this is for educational purposes only. Consult your financial, legal, and tax professionals and use your own common sense before making any investment decisions. Thanks for joining us, and be sure to tune in next time for more Mailbox Money.